Thank you for joining us today for a Zoominar on credit opportunities with Makan Nia, who is Senior Investment Strategist with Manulife Securities. My name is Jeff Hunter. I'm a Portfolio Manager with the Townshend, Somani and Hunter Group at Canaccord Genuity. Also on the line is our lead investment advisors, Dave Townsend and Raheem Somani of Canaccord Genuity. For more information about our team, please check out mywealthmanager.ca. Before we get started, a couple of housekeeping items. Today's call will be recorded, so make sure to check your emails in the coming days for the replay information, or follow our team's Facebook page at facebook.com/mywealthmanager.ca. We have muted participants to ensure that Makan can discuss the sectors and the topics without interruption. And in the chat below, feel free to direct any questions to Dave, Raheem, or myself, and we'll be happy to ask them on your behalf. With that, let's get started. Makan, you're the Senior Investment Strategist at Manulife Securities. Manulife is one of the largest asset managers in Canada. Can you discuss your role with the firm and how it helps you provide a clear view on the markets at all times?
Good afternoon, everyone. Thanks, Jeff. So I'm a Senior Investment Strategist at Manulife Asset Management. And essentially my role and our team's role is wake up every morning and try to make sense of the global economy, the impact that the global economy can have on company earnings, and what that may mean for their underlying stock prices or even bond prices. And then what we do is we look at it from an asset class perspective in terms of opportunities. So that's just a fancy word for what mix you can have between your stocks and bonds for you to meet whatever your financial goal is. But our role is to try to find the best opportunities on a 1 year forward basis by taking in the global economy, what the impact is on companies, and also add into it politics and geopolitics. And it seems like the past 6 months, or not even 6 months, 2 months, we've had to become epidemiologists at the same time too. So it's a very complex role, but every day is different.
Perfect. Do you want to just highlight a little bit of what's been going on in the markets the last couple of months?
Yes, so it's a tale of 2 months, really, or a tale of, so far it's 2 chapters in the COVID story. Chapter 1 was the dramatic fall from the mid-Feb highs, February highs in global markets. We bottomed on March 23rd. We saw close to 35% drop in that very short period of time. And then we've seen a subsequent rally. We haven't reached the prior highs, but we're not that far off. And that's been on the back of a change in sentiment surrounding economies opening up. So when we were in that March, April, specifically March, we were in a dark tunnel and there was no light. And then as economies have started to open up, we were seeing light at the end of the tunnel. We're walking closer to it. So that's been one positive aspect. And then on the healthcare front, there's been positive aspects. So that's led to this environment where you saw a sudden sell-off and then you've seen a quick rally. And that's where we find ourselves today.
Raheem, you had a couple of questions.
Yeah, there's been a number of questions coming in, and we're a big supporter of yours, and we appreciate your reviews. A couple of client questions that came in prior to the call. There's been a lot of rhetoric that traditional dividend-paying companies may find the current environment stressful on the balance sheet, and will either have to cut dividends or refrain from raising them further. For our type of clientele, income is an important long-term consideration, especially for our clients who are probably more executive in their years. Where do you see the opportunities right now? I know we've been focused on fixed income. There is a strong opportunity in a risk-reward play in that sector. Do you want to comment a little bit about fixed income as an opportunity for income investors? That there is substantial potential there, not only to help capitalize on the income from the coupon, but also capital preservation.
Yeah, so maybe afterwards we can talk specifically to stock dividends. I think let's focus on the bond, the credit or company interest rate payment. So I think we often think of companies that just pay dividends with their stocks, and that couldn't be further from the truth. Companies also raise money through the capital markets through bonds. And actually, interesting enough, in the past couple of months, we've seen a record amount of companies raising cash or raising bonds, essentially, or issuing bonds. And what they do is, okay, they take the money in, and by lending company A, so let's use as an example Microsoft, because I know in many of our products that we recommend, we own Microsoft, we own it as a stock, but not in these solutions, but we own the bonds. So Microsoft will raise money, they'll use this money for whatever their business purpose is, and they'll pay a coupon. And that coupon is paid depending on the bond, but it's paid throughout the year. And it's very similar to a dividend. So depending on it, so Microsoft, I think, was paying 4 to 5%. Obviously, the riskier that cash payment or the likelihood of getting it as an investor, I demand more. So, but from this case, when we look at Microsoft, you might think, oh, it's a stock, but actually we've been participating in the bonds. And I think your earlier question, or the earlier part of it was what type of, and this applies to the bonds as well, is what type of stocks, dividends are safe or not safe. And the same applies to bonds. Now, we've talked about COVID and how it's a unique environment. When you look at Microsoft, its business, if anything, hasn't diminished. It's actually flourished in this type of environment. And as a bondholder, I'm very happy to hear that, in the sense that I know the likelihood of me receiving those coupons are increased even greater. But you alluded to it as well, is you can also get gains in terms of the price from the bonds. So not to go too much into details, but bonds essentially mature at $100. Let's just say, for simplicity, $100. So if you hold your bond to the end, you will get your $100 back regardless, unless it defaults. That's a different thing. But generally, that's very low. You get 100. But what your manager buys that at, so let's say when markets sold off, and this was in March, that $100 bond could have sold all the way down, let's say $90. And then us as managers would go in and say, you know what, the fundamental environment from Microsoft hasn't changed. We're going to continue to get these coupons. You know what, at $90, I know I'm going to get my money back at 100. I'm okay with that. And you buy it at 90, and subsequently, because the environment improves, that stock price actually, or not stock price, excuse me, the bond price actually can move a lot higher. So up to, you can even go north of 100. So when people think of bonds, I think we're very similar, just given our experience as Canadian investors. We think of your typical Canadian government bond, and that's fair, but the opportunities from our perspective lie outside of the traditional vanilla Canadian bonds, and they can lie with company bonds. They can also lie, and we call them sovereigns. That's just another, it's really a more complicated way of just saying country bonds outside of North America.
So are you seeing in the bond world more opportunities in North America, Canada, globally? And outside of corporate bonds, a lot of conversation has been around high yield debt. As conservative investors, as investors who are looking more longer term, where do you see the sweet spot going forward?
So let me start off, and I always start with this quote, and I think this is important for Canadian investors. Vanguard, which is a massive ETF distributor, did a survey of developed market investors, and they found that Canadian investors have the highest allocation to their own Canadian stocks and their own Canadian bonds. Said differently, Canadians love Canada. And there's several reasons for this, but one, I think, is because we weren't burnt in the great financial crisis of 07-08. Our banks held up, so we generally held more. Now, when we look forward in terms of the environment moving forward, I think Canadian investors have to become much more comfortable with investing outside our typical comfort zone. So one area there we think the opportunities lie is in emerging market. So basically countries in the emerging markets, or as I say, what's an emerging market? So China would be classified as emerging market. South Korea would be classified as emerging market, but their economies are as developed as ours. So put that aside. But in these type of government bonds that are paying a higher yield or paying a higher coupon to you, so they can, depending on the country, they can range from 3 to 7%. To put that into context, the Canadian 10-year government bond today was paying you 0.5% per year for the next 10 years. And I ask you, what are you going to do with that? So when we look at opportunities, we find opportunities in that part of the world. Now, you may think automatically, well, Makhan, that part of the world is riskier. That's why they're paying you a higher interest rate. And we would argue, and our work suggests, and credit rating agencies whose job is to look at the probability of these countries paying you back, rank these countries on par with us here in Canada, US, or Europe. They have better balance sheets as governments. We can all say here too in Canada and US, look how much money we've spent in the last 2 months on COVID response. So our governments are more indebted. They're less indebted. And then the demographics of that part of the world are much more favorable over even the longer term than ours here. They're younger, they're entering the middle class, they're consuming, they're spending more. So that provides a lot of great opportunities, and not to get too nuanced, but also the credit. And when I talk about credit, all I mean is it's a company bond. And typically in that part of the world, you would rely on the banks for lending. And as they develop and become mature, they are relying more on issuing bonds. So now you're getting companies that are issuing their own bonds that as investors like Manulife, we can invest in them. And there's very certain parts of that part, like there's certain parts of that economy that we don't even have in Canada or the US. So that gives you that diversification. Now you mentioned high yield bonds, and all high yield bonds they're just riskier really a riskier bond than your investment grade. But as a result, you are getting paid a higher coupon for that. So if a high quality company issues a bond, you're looking at anywhere between 2 and 5% that they will pay you. A high yield bond pays you anywhere between 5 and 15, depending on the riskiness of it. Now, when we look back at high yield specific companies, and I think this applies to stocks as well, coming out of COVID, there's going to be certain sectors that they're going to be fundamentally different than what they were pre-COVID. But other parts of the markets will continue. And these are the type of high yield bonds that we're interested in, that where our credit work or our teams will look at this company and say, okay, I'm supposed to be getting, for simplicity, $5, or let's just say 8% this year. What's the odds of this company being able to pay that? So what they'll do is they'll look at their customers. How diversified are their customers? If you're concentrated, if 1 or 2 customers make up the majority of that cash flow, it's more risky. Then they'll look at their industry. Are there high barriers to entry? Is it easy for me to get into that business? They'll look at the amount of debt. And I think this is very important as well, is in this type of environment, Warren Buffett always says, and this applies to stocks and bonds, when times are good, no one's questioning anything. Everyone's just riding the wave. But when times are weak, it's as if when you're standing in the ocean or the lake, and well, I guess the ocean applies to this example, is when the tide goes back, you really see who's exposed. And those individuals that have high, or those companies that have high debt levels are much more vulnerable. So our analysts will look at these companies, are they highly levered or have high debt levels? So when we look at the high yield market today, when we look at stocks, we think stocks have gotten ahead of themselves. But when you look at where high yield is today, despite the rally, it still provides an attractive investment opportunity based on how much yield they're paying. So across the board, across the entire spectrum, when you average the yield, it's roughly 7%, which we think is quite favorable given this environment. And then also the spread, which is just another way of saying basically how much more they're willing to compensate me over a government bond, is also at an attractive level. That when you look back at history, 1 year out, you typically get in that high single digit, low teen return environment. We are always conservative as investors. We say, okay, give me the worst case scenario, an environment like this where they could pay me mid single digits to high single digits. we think that is attractive opportunity from an income perspective.
So on that, and looking in the high yield space, there's obviously different sectors, as you mentioned, that are doing better and poor. What are some sectors that you guys are avoiding or overlooking, and what sectors are kind of poking their eyes out and saying, hey, you know what, these are good things, and they're offering great coupons and at an attractive price to entry?
So without referring to specific companies, just from a compliance perspective, I can speak to a couple, but one sectors that we are avoiding would be areas that are linked to consumer discretionary, or said differently, consumption. So there's high yield bonds that are linked to basically malls, like not grocery stores, but consuming, retail stores. I know Hives, which is a steakhouse, they came to market a couple of weeks ago with a bond that paid me 15%. Very attractive, but is that the type of risk I want to take on in my portfolio, given what post-COVID restaurants look like? No. So areas that are linked more to consumption, specifically in Canada, our managers are shying away from. Carnival or cruise lines in general, or airlines, have come to market. Again, Carnival was another one. You're looking at 13 to 15% paying you. Attractive yield, but how does that environment look going forward? Pretty uncertain, right? So we're okay for foregoing some of that, really those returns. We rather play in the higher quality high yield, in that high single digit, low teens. Is we always continue to look, even within the high yield space, is when we take risk, we'll take risk in our equities. We want our fixed income to act as that counterbalance to our equity exposure. So we'll hold higher quality credit or government bonds. But also today, the high yield bond market's given us an opportunity, given the sell-off, to also add income without taking on too much risk. And when you look at, as I mentioned before, the one way of losing your money in bonds is the company goes bankrupt, because I'm guaranteed if the company doesn't go bankrupt, that I'm going to get that $100 back in my hand at a set time, unless they go bankrupt. And when you look at default rates in the US today, they're still trending in that 4.5% range, which is still quite low. Now, this number is going to increase, but it's focused on the energy space, as an example, a sector that we're seeing more defaults. It's focused on anything consumer related. So those are areas within our portfolios, whether it's the strategic income fund, the yield opportunities, mainly like global unconstrained, that we have shielded away from those sectors that we think are, yes, the yield is attractive, but we're just not comfortable with the risk we'd have to take on as managers.
So just using 2008 as a playbook, I know the credit space did tremendously well over 2008, 2009, after recovering off the lows. Can you kind of use that as a playbook, or what are you seeing there? And then just on second part of that, with the central banks injecting so much money and cutting interest rates as much as they have, does that provide an even further lift, given that rates are now that much lower than they were before we entered this?
So very interesting comment, the last one, in terms of, because interest rates are low, that these companies have lower borrowing costs, so their ability to pay back that interest is higher, and that's absolutely correct. So even when you compare with the great financial crisis, yields today are, let me rephrase that, interest rates today are near the bottom, where that wasn't even the case as we were entering the great financial crisis. So that provides a cushion for these companies. A big difference between the great financial crisis was, and you alluded to it, is the amount of programs that governments, whether it's from the federal government or from our central bank, in terms of the amount of money they have pumped into the economy in the span of 2 months. And really, this happened over a couple of weeks. It took months during the great financial crisis. And that really removes a lot of that potential tail end risk that we saw during the great financial crisis, a major difference, and this is, I think, very supportive of really bond markets, is whether it's a central bank in the US or whether it's our very own Bank of Canada here, they've essentially come and said that if you need to borrow, we'll be that lender of last resort. And if we are going to be buyers of also bonds as well, which we saw in the later half of the financial crisis. So we often get the question is, and none of us have a crystal ball. If we did, no offense, we probably wouldn't be sitting at our computers right now. We'd be on a beach. But people ask, well, Makong, are we going to retest the lows that we saw in March? And the honest answer is, no one knows. And anyone who says that, I think you can add probabilities onto it. And I still think those are a little bit, I think we've basically breached those. But what I can tell you this is, if stocks were to retest that, I don't think bonds go even anywhere close to the levels that we tested in mid-March for bonds. Because since then, these central banks across the world have come in and said, we will be buying bonds. And that's provided a support for credit, for sovereign bonds. And we've seen that in the performance of these individual bonds and these solutions. So that's what that does. And I think just also given the fact that interest rates are likely to stay lower for longer, it provides support for quality companies that issue bonds, because we're all still looking for income. Our retirement needs, the income we need for retirement, has not changed.
Do you foresee negative interest rates on the horizon? There's been talk in the US that if it comes to a position of volatility, that the Fed would step in, and they have underlined this and highlighted this, that there is no bounds to what they will do. Considering growth rates are quite low and unemployment rates are going to be, whether they're exaggerated or whether they now start to remain high as companies become more efficient and don't take back the workforce. Do you foresee negative interest rates on the horizon? And if that is something that is in the playbook, then bonds ultimately at these levels would represent a tremendous opportunity.
My gut feeling tells me that I think the odds in North America are quite low that interest rates will go negative. If there was a positive to interest rates going negative, so just very broad base, the theory behind negative interest rates, because I'm sure many of you are thinking, why would you want negative interest rates, is the theory is I'm a saver, let's say. I am a saver, but okay, so I'm a saver. So the thought is, okay, well, I have my money parked with the bank and I'm earning, let's just say 1%. But then all of a sudden that goes to 0%. Am I more likely to hold it in the bank, or am I likely to spend it? Why am I having my money in the bank? I should go spend it instead, enjoy it. That's the theory behind negative interest rates. Now, we have examples to compare to, and one is Japan, and the other one is Europe. They went along this path of negative interest rates with the hopes of stimulating their broader economy. And our experiences with those two countries has been the exact opposite. It actually did not do anything to spur consumption or spending. And if anything, it made their banks vulnerable. When you look at the stock prices of their banks in Europe and Japan, they have not done well because negative interest rates is obviously a very bad environment for banks. Now, here in Canada and also with the central bank in the US, they have mentioned time and time again that they are extremely reluctant to go negative because they don't think that it's very positive. They think that there's more negatives to the whole financial system than there is if there's any positive. So I think the odds are quite low that we go negative at this point, but that doesn't mean interest rates are not going to be low at these levels for quite a while.
One question that was emailed to me, and a question that is on the minds of a lot of Canadians, is with respect to mortgage deferrals in Canada as it relates to credit. A number of Canadian households have started deferring their mortgages, but the Bank of Canada has mentioned, and a number of the Canadian banks have mentioned, that September, there is unlikely to be any further deferrals.
Mhm.
I don't know if you could comment on this or if you're comfortable, but if you are, the Canadian housing market to a number of Canadians represents a pillar within their, I don't want to say in their investment portfolio, but it's probably one of the biggest acquisitions that they will ever make, and that underpins a lot of their wealth, or it could. Thoughts on potential volatility in Canadian housing, irrespective of where things are today, but maybe down into the future and potential issues that could arise?
Yeah, a lot in that question for sure. And not only is a house an asset for an individual, the financial system, so banks and insurance companies make up anywhere between 20 and 25% of our broader GDP in this country. So they're pillars of they're pillars of the economy as well. Now, take what I'm about to say with a grain of salt, because as the team knows here is I've been very cautious on Canadian real estate for years now, and it hasn't come to fruition. But I will say this is when you look at the debt levels of Canadian consumers, these before this in Canada, and you've seen these statistics, is that for every $1 of income, Canadians have $1.6 of debt. And given what's happened with COVID, that's expected to go up to $2.3, which is astronomical. And then on the flip side, we know what our governments have done. Now, the last thing that people will do in this country is default on their mortgages or on their house unless it's severe financial hardship. So do I see house prices collapsing like we did in the US in 07, 08? No, there's fundamental differences. Does that mean there couldn't be weakness? Yeah, there could be weakness of, and I'm not going to throw numbers out there. CMHC's CEO came out and said up to 20%, which I was very surprised by. But let's say there's weakening. And we always ask ourselves, regardless of the economic environment, how do you make money from your investments in that environment? So let's say the person who sent the email is right, and there is weakness for real estate going forward. How do we make money from that? And how do we how do we reduce losing money? So the banks will be vulnerable in the sense that I think their ability to drive earnings going forward will not be as strong because the housing market may be just flat, but it doesn't mean those dividends are not safe. Those dividends in the past, in the history of all Canadian banks, CIBC has been the only bank that's actually stopped their dividend or cut their dividend. The other banks have never done that. And that was also during the financial crisis. So the other issue is, okay, well, how about all these real estate, if there is mortgage defaults, are they vulnerable to that? Well, these Canadian banks had a very good relationship with CMHC. They've unloaded a lot of that risk to the federal government. So they're more exposed to potentially line of credits, credit cards, but they have plenty of capital on the side to allocate for that. The other areas is, okay, so from your investment portfolio, whether it's your bonds or your stocks, having it geared towards areas that, if you are right and Canada experiences a larger downturn, being in companies that their businesses won't be impacted as much. So we were talking about, one example we were talking about, Manulife is TELUS is a good example because we own its bonds and its stocks. Is if we go into a recession and sustained period of time, are you going to cancel your phone bill? Probably not, or your phone plan? Probably not. So yes, we think that there are going to be challenges for the Canadian economy going forward, specifically because Canadian consumers are in debt. Energy is another challenge. But despite the environment, it's important to look at your own portfolios and make sure, are you shielded from that? And also, how can you capitalize on that? And I think that's what's important with questions like that.
Jeff, did you have some questions?
Yeah, one was just given where interest rates lie, I know the credit markets are not portraying the same as what the Fed's giving out in terms of lending. When things stabilize, do you see a lot of current bonds being repurchased and called back? And then the second part is, given the credit market's effect on the overall markets and how important it is, what what do you want to see in the credit markets first to give you more comfort in the equity markets coming out of this?
So number one with credit, and just for the audience, is when we talk about the credit or the underlying of the financial system, all we're talking about is the plumbing. And what I mean by that is, let's say I owned a home and I had my mortgage and it's the end of my term and I need to renew it. In times that there's no difficulties, it's very easy to renew your mortgage. You go in and you renew it. But when times are tough or things are tight, if I go in to renew my mortgage, maybe my lender is less willing to want to lend it to re-lend it back to me. Or if they do, they want more rate, they want more interest because of the environment. And that has the ability to seize the credit markets. We saw that in the great financial crisis is a lot of these companies to fund their day-to-day cash flows. And for those individuals who are listening in, who are small business owners, you know what I'm talking about is the day-to-day cash flow of your business does not always match the revenue of your business. So in the meantime, you have your line of credit, and during times that are great, it works. But when things get tight or when there's uncertainty, that seizes up. And we saw that happen a month ago during those lows. And that's why the Federal Reserve came in with this unprecedented amount of stimulus. And that's the first, when you say, what do I want to see going forward? That's what we all wanted to see a month ago. And that is a very, very positive thing going forward, that the plumbing in the system, if I have a functioning business, that I can still get my line of credit, because that's what you don't want. You don't want to be a good company and need cash for your day-to-day operations and not be able to get to it, because that becomes an economic issue that bleeds into a financial issue. So that's been taken off the table. What I want to see going forward is the spreads to continue to decrease. And all spreads is essentially, if a Canada government bond is your most riskless asset, and I'm going to buy something that has some risk to it, then there needs to be a spread. And that spread was at its peak in mid-March, and it's come down materially. And as it continues to come down, that just speaks of the health of the underlying credit market. So the first thing was that unprecedented or unlimited amount of borrowing, and we've seen that, which is extremely positive. I can't stress that enough. And then the second is that spreads continue to decrease. And then obviously the third is you want the broader economy to continue to improve. And as you mentioned, these employment numbers to come down, because that also speaks well of the health of that economy and the likelihood of that company being able to pay back that rate, or not rate, but that interest.
Just a question in the audience. Over the next 3 months, are you seeing the S&P market going up with the stimulus or down with the COVID effects? Could you predict percentage up or down? And what are you guys seeing in terms of a second relapse and government reaction to that?
Yeah, I always joke with Jeff and Raheem when we were in their offices, anything less than a year from a time horizon perspective, you might as well ask my 4-year-old daughter, because she probably has as good as odds of picking what it is. But I'll try to anyways. I think when you look at today, and I think it's important to try to understand why we've rallied. So number one is this unprecedented amount of stimulus. From my opinion, that's number one. Number two is opening up of global economies. So that fear of being shut down for months is off the table. Third is developments in vaccines and therapies. And where we sit today, I think the markets are getting a little bit, stock markets, and I'm not talking about bonds. Stocks have got a little bit ahead of themselves in terms of expectations going forward. Yes, economies are opening up, but that's going to be extremely slow, very gradual. We're all trying to use China and Germany as examples because they were one of the first ones into this. They're one of the first ones trying to get out of this. And preliminary data out of China is pointing to, so I use example from this company called Moomoo. And Moomoo gives you real-time traffic data. And their data analysis of real-time in Shanghai and Beijing and other major cities is from Monday to Friday, COVID basically traffic is at pre-COVID levels. But on the weekends, it's like 20% of what it was typically pre-COVID. So what this shows is, yeah, we all need to work. We need to make money. So from Monday to Friday, when we're allowed back to work, if we go into the office, people are going. They have to. But on weekends, when that decision to go out into the general public is up to me, what we have seen in China and even in Germany is people are less likely to go out. So I think, yes, economies are opening up. The worst is behind us from an economic perspective, but this is going to be very gradual getting out. Also, the vaccines, like the vaccine news is, okay, and I mean, when I say guys, it's like I'm talking to the markets, is we have gone from a period that would take 2 to 5 years to potentially they say now, maybe January. Markets move every day based on, so this morning was Merck. And markets popped in the open, and then the Merck's CEO came out and said, well, it's still going to take a year plus. There's that vaccine trial in the UK out of the Imperial College that a couple of weeks ago really started this rally because they said, come September, we're going to have a vaccine. And then they found, because cases have come down so much in the UK, they don't have enough participants to participate in the vaccine trial. So they've gone from an 80% chance of success to less than 50. So we've been mentioning to clients from the beginning, this is going to be a 2-step forward, 1 step back type of process. It's going to be very gradual. The big thing in this type of environment is not to let your emotions get the better of you. And what I mean by that, you have sat down with long-term plans with Jeff and Raheem, and we see investors, and the data speaks to this, is when there's short-term volatility, that investors forget those plans. And in the month of March, and I think this is really important to stress, is in the month of March, Canadian consumer, the amount of money that flowed out of the stock market, the bond market, was the most on record in any given month in history. And what happened in March? March 23rd was the low, and markets have rallied in the US, for example, close to 40%. Those investors locked in those losses. And the reason I bring that up is I don't think it's never a straight line down. It's never a straight line up. It's ebbs and flows. And we will get volatility going into the summer. We'll get volatility for the rest of the year. And if we do get another leg down, it's important to keep note of the long-term goal that you've set out and not to get swayed by by the week-to-week headline news. And the second question is the odds of another one. I'm not an epidemiologist, but I just think that the odds are going to be lower of these full-scale closures for a couple of reasons. Number one is social distancing is going to continue. The events, large-scale events, are going to be limited. Two is essentially the healthcare system is better resourced today. And third, traveling, which was one of the primary causes of the spread, is going to be very slow to come back. So because of these 3 aspects, are we going to get flare-ups in certain areas? Of course. But I think the broad scale, like a large-scale second wave, is probably less likely. And even if I'm wrong and we do get a sell-off, remember, markets ebb and flow. Think of those investors in March that sold out because they haven't seen the subsequent. The majority of us have seen our portfolio values go pretty much back to where we were, maybe off 5%, 10%. But we didn't lock in those losses at minus 35%.
One last question from my side, and this is more topical. And talking to a strategist is always insightful because you guys look at a lot of different data and themes and trends. The structural changes that have emerged because of COVID, whether it's technology, whether it's real estate usage, consumer trends, purchasing, restaurants, what's some of the exciting things that you're looking at? Because we were dealing with a pretty efficient market in January, and we have probably turned a few sectors over, which are probably going to be out of favor for a while. But thematically and looking into the future, what are some of the exciting things that you see when you look at whether it's consumer behavior or technology or patterns that's starting to create an investment theme that you could allocate capital to?
Yeah, so I still think it's still early in it, but some very early where our managers are finding interesting opportunities are in obviously healthcare, I think is one. Now, the industry as a whole has talked or complained that they haven't been properly funded for years, and I think we saw some of those vulnerabilities during this. So I think there is going to be cutbacks in spending in certain areas because of the amount of debt we've taken on. But one area that's probably unlikely to be cut, and if anything, likely to see an increase, is healthcare spending. And that bodes well for the general sector. Also, even within it too, is like company specific. So I use an example of Edward Life Sciences. So what Edward Life Science does, it's the leading heart valve replacement. It basically produces these heart valve replacements. It's the largest producer in the world. And over the past couple of months, we know that non-essential surgeries has been replaced or canceled, not replaced, canceled. And this stock took a massive hit, and their bonds as well. But now we've seen a quick rally is because as we open up, these procedures are going to be back up and running. So it's within that area that we also see some very interesting opportunities, whether it's Danaher with testing or Abbott Labs with their testing aspects, that going forward, we don't need thousands or we need billions of testing, right? So my brother or my dad, for example, he's a doctor. He would need to be tested, and think about this, probably every couple of days going to the hospital, and he needs a rapid test response within an hour. So it's these type of areas within healthcare that are very interesting. One area that's interesting, and we talked about this, and this is very, very early, is now without going into whether this emanated from China or whatnot, but is the reliance on companies on supply chains in China. And one example is, a great example is our pharmaceuticals and our pharmaceutical equipment, not pharmaceutical equipment, but our medical equipment. Not defibrillators. Oh my God, I forget them now. Oh my goodness, the machines that we put ourselves on for respirators, sorry. So one reason that Germany was able to rebound very quickly relative to the rest of us is because they were able to test and they were able to manufacture their own PP&E. And that's because Germany is a manufacturing base, whereas we've outsourced that and we've had to rely on other people. I think you're going to see a trend in very mission control sensitive areas that's going to be brought back from China. It's going to be brought back from India. I think another area is going to be very interesting is robotics in industrial automation. So as we go towards this area of less congregation or social distancing, meat packing plants, we've seen it, is that an introduction of robotics, automation. We're seeing it in airports already. We're seeing this trend in Asia. Another one is essentially scanning. So the ability to real-time scan someone's temperature to see if they have a fever, maybe they are other types of infections. So those are three areas that I think are very interesting, outside the Amazons of the world, the Netflixes, these stay-at-home. And the other one, maybe I'll leave it with this one, is the commercial real estate property. So one argument is I'm a Manulife employee. I was told to basically work from home until the end of May, and that's been moved to the end of August. Now come August, and I'm as productive, and I was just telling Jeff, probably too productive now. Now, does Manulife look at that and say, you know what, a certain percentage of our employees, they're as productive as home. Why am I paying all this money for office rent? So does that reduce the footprints of these basically commercial real estate? Now, there's also the other side, and this is what I'm saying, it's too early from this perspective, is the other argument is that I still need my employees in the offices. So yes, I may have less employees in the office, but I need more space in the office. So when we look the big picture, I think the ones that are definitely, you see the writing on the wall that is likely to be sustained. Number one is the aspect of healthcare. There's going to be more and more money pumped into this going forward. There's going to be a lot of benefits for companies going forward. Also automation, also industrialization. And these are things that I think just got fast tracked with COVID. they're already on that way, like the Amazons of the world, the Shopifys, they're on that way. This just got, it really pushed it up much faster.
Just quickly, got a question here. What is there any other sectors or investments, whether it be traditional or more of an alternative, that you see for helping hedge portfolios over this next little bit as we continue in more or less an uncertain time?
Downside protection, do you mean?
Yeah, just as kind of risk-off assets as well that show some opportunities, or other ways that clients can look at to say, okay, well, I wouldn't normally do this in a regular environment, but adding some of this in this current environment might not be a bad thing until things go back to normal.
So my point to that is I think you should always have those defensive levers in your portfolio. The reasons for that is the markets time and time again have thrown you surprises that no one could have anticipated. And you need those defensive metrics or defensive levers in your portfolio to provide that downside protection in the event that it comes, or in and when it does come. Investing is not just a straight path up. And like I've mentioned countless times, there's always these hiccups. No one saw COVID-19 in the cards. No one saw, let's go back to the European financial crisis. I remember Greek was on the front page and people were saying, well, why do we care about Greece? It's only 2% of the European economy. And we saw what happened. Or during the great financial crisis, the subprime loans, I remember on the trading floor, people say, why do we care about subprime loan? That's only 2% of the overall loan book. And you saw what happened. So it's always important to have those defensive levers in there. And I think the first one was always fixed income or your bonds, and having bonds that, and I think some investors, and thankfully not our investors, have seen that they thought they were owning bonds that were less risky than they actually were. So in the time of that sell-off, their bonds didn't sell off as much as their stocks, but it did not provide that counterbalance that they were expecting. Where I look at our mandates is for strategic income, for example, looking at it today, I think it's basically up 0.5% or 1%. And that it's fit the mold of what it was supposed to do during the downturn, is to protect on that downturn. And then also within, as we continue to enter this uncertain environment, is even within your stocks or even your bonds, the companies that you own, I can't speak to the importance of analysis and credit analysis and stock picking. Is during these times, our stock pickers can go through each one of these companies and look at the various characteristics. Now, that's also important coming during this period, is to see, okay, if we have this period of weakness going forward or slow recovery, can this company sustain it? And historically, companies that are able to ride the wave in terms of their business models are ones that aren't price takers. So what I mean by that is the underlying thing that they sell, they have a control in terms of that price. Number two is companies that are not overly levered. Is we always know that companies have a lot of debt during times like this or weakness, they're going to be much more exposed. So you can also do that type of environment or type of analysis, or have managers that do that type of analysis for stock picking for your stocks as well. And for those that want to have so we talked, well, we have not on this call, but in terms of government spending, what does that mean? Gold is also, for some investors who are comfortable with it, an interesting hedge against that inflation, or hedge or protection against volatility. And we've seen gold act like that over the last really 4 to 6 months.
Perfect. Well, thank you very much for your time, Akon, and Henry, and the rest of the Manulife team behind you. We appreciate everyone joining us on the call today. We're just kind of up for time. If you have any additional questions, feel free to email either Dave, Raheem, or myself. We really appreciate everyone's support and interest. Again, make sure to check out our website at mywealthmanager.ca, or follow us on Facebook at facebook.com/mywealthmanager. It'll keep you posted with the additional Zoominars and interviews that we do, and some other resourceful information. If you want to discuss your individual portfolio or investments, again, feel free to reach out to either Dave, Raheem, or myself. We're more than happy to help. And with that, I'll end it off right there. And everyone have a great day and stay safe out there.